How's my end?
You're coming through.
All right, good. You know what? Let's just get started right away since you might have to dip 5 minutes early, and we want to extract as much knowledge from your brain as possible during this time.
Sounds good. Let's jump into it.
All right, let's do it. So I read your investor letter. Always a good read. January 2025 investor letter for the
Thank you.
MJG partnership. And so page 2, you say, we soldier forth, armed with the knowledge that the mining sector has now been starved of capital for the better part of a decade. And then you show a graphic showing the proceeds, capital raised from companies on the TSX venture.
That's an ugly one, isn't it?
Yeah, and then you also say that it's not just the TSX venture. The world's 40 largest mining companies have invested, less than 30% of EBITDA into CapEx in comparison to 70% of EBITDA during the 2012 to 2015 period. So it's not just a Canada thing. It's not just a small cap thing. It's across the mining industry. So I guess the first question is, before we get into the 2024 performance and sort of where we stand today, is why do you think the extractive, industries in the world are being starved of capital?
Well, I'd say a few reasons. First just comes down to price. Gold is an obvious exception in the past couple of years, but we have had depressed metal prices largely across the board since the mid 2011 peak, and that remains largely true to this day. Though we have seen a bit of a recovery in recent years, but I think metal prices are a huge variable. It's also the sins of the past of the mining sector. Particularly on the gold front, very profligate uses of capital in the later stages of the Chinese-driven commodity supercycle. Companies taking on debt for acquisitions, companies buying and overpaying for large, low-grade deposits on the assumption that metal prices were gonna rise indefinitely, and ultimately getting their asses handed to them in the 2012 through 2016 period, tremendous write-downs across the space. And I think rightfully, at least for a certain period, being penalized pretty heavily by the investment community. So I think the management teams, of many of these companies, and, a driving motivational factor for a lot of these groups is self-preservation at the end of the day. They've learned that lesson, perhaps overlearned that lesson. But it's, the MO over the past 10 years is it's better to sit on your hands, pay down debt, return capital to shareholders, and not take any big risks, particularly in terms of, starting on new greenfield projects and bringing new supply into the world. So I think the combination of prices and also the sins of the last cycle and the learnings that management teams have taken from them. And then the third variable, of course, would just be, where investment capital is concentrated currently. And it's been just an incredible run for, high-flying tech stocks. Obviously, a huge amount of speculative capital remains in cryptocurrencies. I checked this morning, we're at $2.6 trillion combined market cap if you look at all the various cryptos that are out there. Even just putting one's money into the S&P 500 and leaving it at that has been an incredibly profitable strategy, really, since the great financial crisis. And so the cost of capital for these miners is higher than it would be otherwise, just because investors, for the most part, are focused elsewhere. So I think those would be kind of the key factors that explain where we stand.
Yeah, so looking at Freeport and, some of the bigger gold companies like Barrick, Freeport has $4 billion in cash as of its latest financials, and they don't seem to be making, a lot of acquisitions right now. They're not, investing in a whole bunch of new projects. And I think the same is true in the gold sector, where actually they're divesting projects, their non-core projects, and just focusing on their tier one assets, their so-called tier one assets that are the biggest that they have, that with the lowest cost, of their assets. So when you have the bigger companies not investing and not really buying, the juniors, is this setting up for a problem in the future where the prices of copper, of, cobalt or what have you are going to basically soar at some point because there's just not enough of it to meet the market? And is the mining industry sort of, are they trying to cause this problem through their small investments?
Well, I think to your first point, unquestionably, I view it as a coiled spring, and each year that passes without the shortfall in capital investment being addressed is ultimately going to make the move to the upside more explosive. And of course, it's hard to predict exact timing, whether this is a phenomenon that really plays out later this decade or early into the 2030s. But again, each year that passes without significant amounts of capital going into the ground to bring on new greenfield supply is ultimately going to make the shortfalls later more significant later this cycle. And as we understand, but many of those out there in the investment community don't. It's not as simple as flicking on a switch to turn on a mine. Even compared to oil and gas, oil and gas is it's easy, one would say, to get a new field into production. That's of course an overstatement, but compared to the timelines that are necessary to bring on new large scale projects, I mean, it's most apparent in the copper space. Like if you're going to be bringing on a major copper project that can make a significant contribution to global supply, and you're starting from scratch, even when you press that go button, we're talking 4 or 5 years realistically before, if all goes to plan, one can get to nameplate capacity. And there's of course the risks of delays to that timeline. There's the acute risk of capital cost overruns. And, these groups are somewhat technically constrained. Like another key aspect here is there's not a lot of new talent coming into the mining space. And even the world's largest companies don't have the ability to go out and build a couple major copper mines simultaneously. If anything, you're seeing them team up with other large players to kind of carry the burden on the technical and the resource front. And so once we start feeling the problem as a society, and that's what gets me so excited really about the whole space, but copper is a prime example, is there's going to be a multi-year lag between where higher prices are evident to society, but before supply actually makes it online. And that's why we've seen in previous cycles, and this is, pointed out by Brian Dalton, him and the team at Altius suggests that the incentive price for new greenfield copper projects is around $6 per pound. And he looks at that, it's a pretty simple way to look at it, but I think it's a good back of the envelope estimate. Basically looks at the capital intensity of copper development projects out there, and then backs out the copper price necessary to yield a reasonable, IRR, which, one would probably say is around 15% or in the mid-teens in order to make those projects tick. But in past cycles, because of this lag dynamic that I've just discussed, you'll oftentimes see the actual metal price reach, in some cases, 2 times or even more than what the incentive price is before that supply response actually comes online and actually starts being absorbed by the market. And so, this is a phenomenon that, people need to keep in mind. And again, I think it's lost on the general investment community as they look at metal prices more broadly.
Yeah, I think that's an important point that you make is during a bull cycle and during mania in a metal, the price can absolutely go parabolic, and it can really overshoot to the upside. And we've seen that in a few metals in the last, decade. We saw it in cobalt in 2018, et cetera, et cetera.
Yeah. I will say it's somewhat metal specific. I mean, you have to look at the type of project, you have to look at the size of the project, you have to look at the actual metal. Like you can reasonably bring on a relatively small or medium sized gold mine, in a 12 to 18 month period if you execute to plan. But for other metals, copper's, comes to mind. Nickel is another big one, especially if you're looking at nickel laterite. Those are half decade projects, if you get it right.
Yeah, and you need a smelter, which like a lot of people don't understand that whole part of it, where you need a smelter, which is very expensive to build.
Yes, yeah. So it is somewhat project specific, but the timelines we're talking here are multi-year. For the metals that make society tick. I mean, even lithium. If you look back at the lithium projects brought into production over the past 20 years, it's actually been the fastest timeline of all metals. I think from recent data has shown that from discovery to first production at the lithium projects that have been brought online, we're talking 7 to 8 years. Where copper, it's double that, 15 and a half or so, and nickel I think is the metal that's most extreme at that 17 years off the top of my head. But yeah, even with lithium, especially if it's a brine project, it's a multi-year process to calibrate one's processing facilities to actually be able to create that battery spec lithium. So this is difficult stuff, really, really across the board.
All right, let's talk about 2024 and the MJG portfolio. So you were up for the year as a partnership of 6.76%, net of all fees and expenses, but you were up, you write that you were up at one point in October, 30%. So what happened in Q4? I definitely feel your pain, by the way.
Yeah, it was an incredibly frustrating end to the year. I got a little ahead of myself in late October. I was looking forward to reporting strong results to partners and raising some significant capital off of the back of that. And November and December resembled Chinese water torture. Really watching the portfolio drift lower, seemingly on a daily basis. But before we get to the reasons for that, and I'm interested in your thoughts as well, I just make a broader point that if you had told me going into 2024, if I'd gazed into a crystal ball and I had seen clearly that the gold price was going to be up 27% over the course of the year, greatest annual performance since 2010, and you had told me that mining M&A would be at levels, not seen in over a decade. There was a real flurry of deals throughout a lot of 2024, but especially in the second half of the year. So a significant amount of M&A activity. If you had told me those two variables would be at play concurrently going into 2024, I would have expected the MJG partnerships return and the returns of many junior investors that are listening, to this program. I would expect a return to be closer to the 113% that we posted in 2020, and not the anemic, single digit return that we ultimately posted. So it was extremely frustrating from that perspective, and somewhat confusing in a way, to be honest. In terms of what we saw in November and December, well, I was taking a step back. 2024 was characterized by strong metal price performance, at least amongst the two key bellwether metals, which I'd say are gold and copper. Definite weakness, especially in the battery mineral space. Terrible year for nickel, terrible year for cobalt, rough year for rare earths. But if you look at the two metals that are most significant to investors listening in right here, it was an extremely strong year. We discussed gold already. I mean, copper ended the year up 8%, which isn't necessarily something to write home about. Still pretty strong price performance. But you'll remember in the spring, we had copper prices as high as $5.20 a pound, and even in early October, You remember copper perked up to 460, even 470 per pound for a short while there. So strong copper prices throughout the year. But it was really a story of metal equities really across the board just failing to keep pace with metal prices, let alone providing the leverage that one would expect to see. That's the typical phenomenon that we see. But there was a period, after the juniors had been moribund basically the entire year, there was a 4-week period from, late September into that 4th week of October where it really did feel like they were taking off and we were having a significant breakout there. We went from, low double digit returns, we'll say in the second half of December year to date, to up over 30% year to date by that 4th week of October. And that was an exciting period. It looked like we were finally having that reaction in equity prices, juniors included, that one would expect to see with the strength in metal prices that have been exhibited across throughout the year. But that turned on a dime, and I would pinpoint to the day the Newmont earnings miss Thursday, October 24th. It's throwing an absolute wet blanket over
Damn
the
it,
space.
Newmont.
They killed us.
They really fucked it up for us.
Yeah, if you look at the charts of most any junior in your portfolio, certainly precious metal focused, but even non-precious metal focused, you can pinpoint in a lot of cases the high of the year to that exact week, if not that exact day. So that was an absolute momentum killer, to a degree that certainly surprised me. And then that was compounded, I would argue, by Donald Trump's reelection, just a week and a half later on November 5th, and the resulting U.S. dollar strength that we saw on the back of that, concerns about tariff war starting and the effects on the Chinese economy, which is obviously a massive consumer of commodities across the board, and also a dip in the gold price. And interestingly, the price action of both gold and the U.S. dollar eerily resembles the aftermath of the 2016 election and what occurred in the 60 to 90 days after that. So we'll see if history continues to repeat, but it was actually a very, very similar reaction to Trump's first electoral victory. But I would argue those were the two factors that led to what was just a miserable November and December period. I pointed out a few numbers in the investor letter. If you go to the GDX and go to that 4th week of October, it was up 43% year to date, ended the year up 9% year to date. You look at the GDXJ, that was up 47% in that 4th week of October year to date, ended up the year 13%. If you look at the COPEX, the world's ETF of the world's largest copper miners, that was up 30% year to date earlier in October, but still in October, ended the year up 2%, just barely in the green. So that drawdown was universal, and it occurred from the largest of the producers down to the smallest of the junior explorers. I'm interested if you have any other theories for the forces that caused that very sharp 60-day drawdown.
Yeah, I just remember sitting there on election night, seeing the Trump win start to become clearly evident, and then staring at the gold price trading north of 2750, and then stupidly not realizing that this was a great opportunity to short gold because of what was going to happen to the dollar, and treasury yields were about to rise because of the fears around Trump tariffs and just what is perceived, at least at first, as pro-dollar policies that are going to cause a flight to the dollar due to the tariff uncertainty. And so now that's passed, and obviously, I missed that trade, as did many. But yeah, you're right. The Newmont earnings were a real wet blanket on this sector. And I think just really, it's painful when we're sitting here with 2,700 plus gold, and the biggest gold miner, the one in the S&P 500, the one all the generalists and the TV talking heads talk about, just disappoints basically 75% of the time when they report earnings. And so it's like, from a junior perspective, it's like, well, if the big company can't do it, then why am I going to own the small ones, right? And when their corporate strategy is literally to sell off assets, raise cash, and buy back their stock and pay dividends, that's their strategy as a corporation. Yeah, we're just going to sell off all the stuff that we've got, and we're going to take the cash and just buy back our stock and pay dividends. So there's no original thinking. There's no investment in the industry. And so I think it really puts a damper on the sector. And I think we did see that for the final couple months of 2024. Now, that being said, so that was the glass half empty take. Glass half full, I think Newmont's actually going to report a good quarter here in a few weeks. And, I think they could actually, beat and, sort of shock maybe the low expectations that the market currently has. So fingers crossed on that. And then also,
not to pour cold water, but Barrick probably won't, given the situation in Mali. I think
I've given up on Barrick.
Yeah, I think one could argue though that's already priced into the share price. So I guess we'll see in a couple weeks time here.
But let's talk glass half full just for a second. So yeah, I think the dollar was also a big headwind for the venture stocks, and also when the 10-year yield jumps 100 basis points. I mean, that raises the cost of capital. There were a lot of moves in the forex markets that were not good for Canada. So I think that was a headwind as well. So there were just a lot of headwinds that sort of formed at the end of 2024. But that being said, it's a new year. I think the dollar may have peaked here in January.
Yeah,
And
if you look at Trump's first term, the dollar was exceptionally weak, really from the moment he took office through at least the first 18 months. So we'll see if history continues to rhyme. But if that turns out to be the case this time again as well, that would be a certain tailwind to metal prices and, by association, mining equities as well.
Yeah, I think Trump has made it pretty clear he wants a weaker dollar. He wants the Fed to be dovish. So we'll see how that plays out. But final point, then I want to hand the floor back to you. The TSX Venture Composite weekly chart has formed a very well constructed 24 plus month head and shoulders bottom pattern. We just need that fuse to be lit for a breakout above 630, and this could be a beautiful thing. Okay, so fingers crossed for that, Matt.
Yeah, fingers crossed. I saw that chart. I saw that chart that you shared. I don't disagree with you. It's very rare to see a triple top. Additionally, the political dynamics in Canada are really interesting right now. I mean, we've gone through 10 years of Trudeau now, and it's looking like there's going to be a swing right at the national level. We'll figure out whether that's the case definitively in a few months here. But also the cap gains tax is dead in the water there with Parliament suspended. So on that level, there are some clear tailwinds for Canadian equities. Particularly the beaten down natural resource space, let alone potential permitting reforms and other governmental support that could occur with the upcoming administration. So that's another thing to keep an eye out on. I do note the TSX-V, I think, is up only 4% year to date. So it's been a positive start to the year, not a screaming one. Glass half full, it's been a very strong start to the year from an MJG perspective. 3 of our 5 largest holdings are up at least 17% on the year. So I'm not sure if other investors are seeing that within their portfolio. But hope springs eternal, and it actually has been a pretty exciting 4 weeks here to start the new year.
Well, that's fantastic. Knock on wood. So in your quarterly letter, starting on page 5, you talk about when to pass on a private placement. You actually put quite a bit of thought into this and 3 full pages on it. So just short summary. When should an investor pass on a private placement financing, man?
Well, the very important point here is I would argue one's view on a private on whether to participate in a private placement actually shouldn't be all too different than one's view on whether to buy a company in the open market. Like first and foremost, first principles here, you should be backing a team that is well incentivized, ethical, operating within its circle of competence, a project with enough scale to matter. And if it's a development stage project, hopefully works at least on paper at spot metal prices, if not lower. A serviceable financial structure, upcoming catalysts in the calendar with the potential to drive a real share price re-rate from current levels. A price that is at a discount to fair or expected value, depending on the stage of the company. And also an investable, jurisdiction and target commodity that makes sense in an absolute sense, but also within the context of one's existing portfolio. So I think first and foremost, it has to check all of those boxes, and investors should refrain from getting carried away by terms that are too sweet. That is a trap that I fell into in my early days investing in this space. And there are exceptions, particularly in the depths of bear markets.
What's an example of terms that are too sweet?
I would say a full 5-year warrant, no accelerator, is kind of the sweetest of terms that one could imagine. I guess another variable to consider is the premium between the common share that one is receiving and the warrant strike price. And the less of a premium, the sweeter it is from an investor perspective. And I'm not saying to reject deals with sweet terms out of hand. And again, in the very depths of bear markets, even the finest, most reputable management teams will sometimes be forced to include terms of this nature. But I would argue, while times are certainly rough, we're not in a 2015 like scenario right now. So the teams with access to capital that know what they're doing, have been previously successful, are able to raise with much more reasonable terms. Instead, there are cases where all of the above criteria are met, everything that we've discussed, but where the private placement should be avoided, or at least an investor should be very cautious about participating, and that's where the list comes into play. And I basically laid out 15 different circumstances where, even if it looks good on all these other criteria, it should give the investor at least serious pause, at least in terms of participating. And kind of the 4 general buckets that these points fall into are the other participants in the financing, the pricing of the particular deal, the timing of the deal, and how the proceeds of the financing are planned to be used. So I'm not sure if you want to go through them one by one. That could be a bit exhaustive.
No. Let's just talk about the key points. Like, I wrote on my Substack on Tuesday afternoon, and I basically took a little screenshot of a portion of what you wrote. So board and management participation is important for you, and other investors who are warrant clippers. So maybe just like a few of those high level points.
Yeah, on the participant front, our board and management stumping up cash themselves. Extremely important point. Our major existing shareholders following on with their investment in a pro rata nature, and if they're not, is there a really good reason why they're not? And then, in terms of other participants, maybe newer players that are coming into the story, do they have a history of warrant clipping, which is the concept, at least in Canadian markets, of buying into the placement, holding for 4 months and a day, and then indiscriminately dumping the common shares and clipping that warrant for upside? Or do other players coming in do check swaps, where they're in essence putting in money and then getting back some or all of that money by performing usually marketing services for the company over a set period of time. And those are very, very rarely worth their salt. I do take pains to emphasize though that I would consider not just these these four that I discussed, but really the whole list of 15 to be what I'd call yellow flags. I wrote a similar piece in the January 2024 investor letter, so a year ago, talking about 25 management red flags. So if you see any of these, you really should look the other way. Here there are circumstances where one could observe one of these phenomenons and still make the decision to invest. One example, just in terms of board and management participation, is a CEO who's not independently wealthy and has a large percentage of his or her net worth already invested in the company, is averaged in at a cost basis, relatively close to the current price per share, and is not participating in the financing. The CEO's lack of participation is not necessarily a reason to throw the deal out, ad hoc there. I'm a little bit stricter if they're warrant clippers, because that's just not a strategy that I employ in the fund. It can actually be a quite profitable strategy. But once you get that reputation of being a warrant clipper, you get priced out excluded understandably from the most desirable deals. Because which management team would want to bring on an investment group that practices that? And then check swaps, I'm also a lot less sympathetic to. But in terms of the full list, there's really only a couple that I would say are like absolute deal breakers. One of those deal breakers would be a private placement that's conducted less than 4 months after a previous private placement has closed. Particularly if the terms of that deal are different or worse from an investor's perspective than the financing that had just closed less than 4 months before. And the reason for that is there's often, even without the participation of tried and true warrant clippers, there is often shares that come out into the open market after that 4 month and a day hold period. And if you participate in a deal where there's a hold period ongoing, you subject yourself to that selling pressure. So I'd say that's one to really keenly avoid. And then another one is a financing right before a significant expected catalyst that the company is already well funded for. So a well-funded company that, is planning to put out a significant, PEA, first time we've seen economics attached to the project, or a maiden resource, or, a significant follow-on phase 2 drill program after an exciting initial discovery. And say you're expecting, said catalyst in June of 2025, and you're aware that the company has, cash in the bank that will take them through the catalyst and into the second half of next year. And then come May, 30 days before this catalyst is due, the company announces a significant financing. That says to you as an investor that bad news is in the offing. If the company knew that the results of that resource or of that initial economic study or of that follow-on drill program were going to be greeted kindly by the market, a responsible management team, adhering to the fiduciary duties of their shareholders, would wait to let that catalyst come out. The share price would re-rate to a higher level, and then they'd raise the necessary funds at a lower cost of capital. So that's another key one to look out for. And we saw a couple instances of deals like that last year.
Very good points, Matt. And you touched on one that I was going to ask you about, but let's delve in a little deeper on that. So something I've noticed over the years and something I've been on the good end and the bad end of several times is when a company announces a private placement with assays pending. Mm-hmm. So let's say they drilled in June. It's now September. Maybe the drilling was done in August or something like that. It's, so now it's a month after the end of drilling. Assays are pending for a number of holes, and then they announce a financing. Is that a red flag for you? Is that like, well, why are you doing this now? Let's see all the results.
Yep, that falls into that exact category. I guess, some nuance can even be applied here. Like if they're in the midst of a 40,000 meter infill program to upgrade their resource into known areas of the deposit and, opportunistically choose to raise funds. That might be one thing. If they're, another case would be doing geotechnical drilling, which has very little likelihood of advancing the share price unless there's an unexpected discovery made in such drilling. So I would define it as a catalyst that you view as potentially significant to the share price. But if you're a junior explorer working on an earlier stage project, any drill program is by definition a potential share price catalyst. And if you have a company doing a few thousand meter drill program to either extend mineralization or make a brand new discovery in a mated drill program, and they have assays pending, and you see that financing, that falls exactly into the category that I'm discussing.
Yeah. So yeah, I'm referring to a junior explorer where the assays definitely will matter, and if they're dusters, they're going to matter to the downside, and if they're great results, then they'll matter to the upside. But the company chooses to do a financing in the meantime. So let me play devil's advocate and let me act like I'm a CEO of a junior miner. And they say, well, we did the drilling. We announced the first set of results. We have more assays pending for sure. But, we're down to 500,000 in the treasury, and we don't want to, we want to get the cash in the treasury while we can. We've had some investors who expressed interest in writing a check. So we want to get this done by the end of the year, and there's no reason to wait. So, what would you say to that?
Well, I would say, great, take the money. It just won't be a check from MJG Capital. Would probably be my initial response there. And I guess, maybe this is a snide response as well, but, if the company had been more judicious with managing its working capital, it wouldn't be, in a position where they're running on fumes in the midst of a drill program. And, look, I understand it's an extremely capital constrained industry at the moment. And, it's not easy to go out there and raise. But if a company is doing things properly, the ideal is to have, plenty in the bank for runway, beyond any catalyst that one is pursuing in the immediate term. And if that's not the case, then, there are plenty of other fish in the sea for investors to look at. So that would be my pushback against that circumstance.
Yeah. I think that's a fair response. And I think that's something that some companies that companies need to understand. If you raise $3 or $4 million on a certain set of goals that are going to be accomplished, investors want to see you accomplish those goals prior to announcing yet another financing, right?
Right.
And I think that's really important. So when companies push these financings too quickly without the, results and the key milestones being met, they get pushback.
Sure.
And they probably should, right?
Maybe do a slightly smaller drill program in that scenario. Because another issue with not having enough fuel in the tank, much beyond the next catalyst, is even if you do come out with good news, a reasonable response of an investor is to say, well, why would I buy in the open market and push up your share price? I know that you have to finance in the next 60 or 90 days or the lights are going to go out. So I like this news. I'm interested in investing, but let's see you announce a financing, and then I'll take a piece of that as well. So that's called the financing overhang, which can even suppress the share price reaction on a positive news.
Yeah, the financing overhang. I know it all too well. So, and that's a very important point, because there's companies who are putting out good news here in January and they're not getting, the response in the share price. And that's really usually because investors know, well, I know you're going to have to announce a financing in the next couple of months. I'm just going to wait for that to be out of the way. So how can companies do a better job of avoiding that? Because it's a real killer.
Yeah, it's difficult. Yeah, particularly in this type of environment. One way to do it is to pursue a different business model. The prospect generation business model is very much out of favor at the moment. But one way to go about managing times like these is to bring in bring in bigger parties to advance the project on your behalf. Maintaining a lesser stake in the ultimate outcome, but also maybe allowing yourself to get a couple different shots on target instead of going in on a single exploration project. Not by definition will occasionally take punts on pre-discovery explorers, but usually if I'm jumping into an exploration stage name, I prefer for it to be on the back of a discovery hole. And if it's an explorer that's pre-discovery, there's a company called Scout Discoveries that we're both invested in would fall into this category. Ideally, they're plenty cashed up, which is absolutely the case for Scout, and also have multiple, projects to cycle through. So they're not pinning their hopes on a single asset. So I think one reasonable approach for investors is just to avoid, single asset pre-discovery explorers entirely. And even if you really like the prospectivity of the project, like the team, like the story, just follow closely and hop on the back of the major discovery hole should it occur. And sure, you might pay 50% or 100% higher price than you would have otherwise. But then you have that certainty that the company is off to the races and not spinning its wheel, trying to raise capital at depressed levels and, to keep the lights on.
All right. I'm going to leave it to you which topic you want to pursue next. We could talk about the Joy, discovery in BC, which just happened and really lit a fire, under a few stocks. Or we could talk about portfolio holding of your choice, or we could talk about both.
Well, it's a world of opportunity here. Well, you were just up in Vancouver for the conferences. I was heads down on the later stages of the lever, so I was not able to join this year. But I do imagine that the Aurora discovery, between Freeport and Amarc was the talk of the town. Is that fair to say?
Yeah, at MIF, when they presented, it was standing room only. I've never seen the room as full as it was for that presentation, and definitely there was a lot of talk about it, and the spirits were high.
Yeah, I think that's fair to say. Yeah, I mean it's exciting. It's good for the space. I'm thrilled for Amarc shareholders that are up 200% plus year to date. TDG shareholders. TDG is a project just to the west of the discovery, just a few hundred meters. Have done even better. They're up 250% year to date as of yesterday's close. Yeah, one that I'm following closely. We have no exposure to the story. It's been relatively well discussed, but I mean, phenomenal intercept, nice widths, excellent grades, very close to surface. A few points that maybe not everybody has considered. The first is I find it a little curious that Amarc is insisting on portraying this as a copper discovery. Like it really is a gold discovery with the copper kicker. Maybe I'm getting caught up in semantics. It's more of a complaint that a geologist would make, but yeah, a good 70% of the value there is gold. Perhaps they're doing this because they want to cater to their partner Freeport, who clearly is a copper focused company first and foremost. Perhaps they're doing this because they think it will engender a stronger reaction from the market. Thinking that copper is maybe something that investors would be more interested in the Golden Triangle. Either way, I would classify it as more of a gold discovery than anything. Second point of interest is what Freeport decides to do here. They have a really interesting deal with Freeport, where Freeport has to spend $35 million to earn an initial 60% stake. And then has the option to spend another $75 million. That's the interesting part of the deal, just the sheer sum of the numbers involved here, to increase their project level stake from 60 to 70%. Freeport is coming right up to a decision point here. To my understanding, $34 million has already been spent in the past 4 years of work, and so they're $1 million away from deciding whether to take that step to 70%, or they could, in theory, convert it immediately to a 60-40 contributing JV. My expectation is they will probably or very likely go for that 70% stake, and continue to carry the burden of financing for the next 75 million in expenditures. But I have had one, very astute member of my network who's close to the story that has, I'm at least leaving open the door for the possibility that Freeport plays hardball here and immediately goes to the 60-40 contributing JV, which would put Amarc under significant amount of pressure. So that's another thing to look out for, and I imagine we'll get to that decision point here, late Q2, early Q3. And yeah, then the big question is whether this is big enough for Freeport ultimately, and that has implications, of course, for Amarc, but also for their neighbors, TDG. The ore body seems to be roughly 180, 190 meters in thickness, tabular ore body that's extending from the east to the west. I think roughly 600 meters have been defined so far. I guess one potential concern is the mineralization seemingly drops off almost entirely once you're through that initial 180 meters. So I think it would be more exciting from a scale perspective if the copper and gold grades continue to depth, even if they were at much lower grades than what's exhibited in that tabular body that's been intercepted. So there is definite risk for Amarc that Freeport starts on the 75 million, stage 2 earn in, spends another 10, 15 million over the next year or two drilling it out, and then decides that this is just not Freeport sized. And at that point, Freeport could be extremely cooperative and work something out with Amarc where they vend in their 60% project level interest for shares in Amarc and let Amarc take the project forward on a 100% basis. Or more likely, Freeport will just sit on it, and they have 5 years to spend that 75 million. So that takes us into mid to late 2030 before they have to achieve that. So that there is distinct risk if they're not convinced internally that it's big enough to matter to a company of the size of Freeport, and that of course affects TDG as well, who ultimately, if this does come to pass, will be part of a consolidation play in that area. Just the timelines might be longer than investors would hope. So those are the different circumstances that are playing in my head at the moment. But I hope for investors in both of the names. I know a few members on the TDG board that this really pans out. It's good for the space, and I understand the excitement in the market. You don't see grades at those widths, starting less than 100 meters from surface very often. So it's awesome to see.
Yeah, I mean, it seems like the scale potential is substantial here. There's a lot of room for this to grow. And yeah, fair point. The drilling, at the Aurora, deposit seems like the grades do drop off in depth, but they could definitely continue to step to the west and see if the high grade extends west. I think there's definitely some room to grow. And as far as I understand it, there's still a few holes with pending assays, so we'll see what those show. But yeah, very, very good drill results. Fair point about the copper equivalent grade reporting. That is a little odd, but you're right. I think they include in it is for Freeport, but it's 70% gold. I mean, the copper grades are good.
Sure.
But you wouldn't build a mine probably just on the copper grades if the gold wasn't there.
No, not in that part of the world. It is extremely remote up there. And I will point out from TDG's perspective, I'm very skeptical of area plays, generally, and particularly in the Golden Triangle, just because it's a really big country up there. But TDG is legitimately just a few hundred meters away from the discovery hole, and it looks reasonable that the mineralization does trend onto their property. My understanding is they have drilled near the property border, but really only to depths of 200 to 225 meters. And, with the current geometry we're seeing, it's more likely that if this tabular body does trend onto TDG's Shasta target, that it would be closer to 400 to 500 meters of depth. So they've just announced the financing within the past couple of days. They'll be cashed up to go ahead and test that. So that will be something to watch as well, in addition to the remaining assays from Amarc.
Okay. We got about 10 minutes. So if somebody has a quick question for Matt, you could step up and I'll call on you. If not, we could end with, again, a topic of your choice. You want to talk about a financing that you're participating in or a company in the portfolio that you want to talk about a little bit?
Happy to touch on Koryx Copper. I'm not sure if that's a name that you've talked about, Robert, on your spaces, or that you've been following.
I wrote about it twice.
You did? Okay, good. I thought I'd seen some content from you on that front. That's our latest investment, and that goes all the way back to June 2024, if you can believe it. So we've gone a full 7 months without initiating any new positions. I do anticipate that will change this quarter. But Koryx was the subject of the featured investment for the latest MJG letter. And there's a good 12, 13 page write up on the company. If anybody's listening or interested in reading up on that, that's at mjgcapital.com in the investor letters section. But yeah, latest investment for the fund, really at its core, a bet on people, first and foremost. This is the latest vehicle of Hayadon and his partner, Alan Friedman. And it's a Namibia-focused copper porphyry, one of the very largest porphyry projects in Africa. I think we're just under 800 million tons total for the resource, but with the amount of drilling planned this year, there's no question in my mind this will be north of a billion tons in short order here. And this is a group that has, within the past 10 years, I guess 12 years, has monetized 2 separate projects in Namibia for a combined total of 550 million Canadian. So I view it as absolutely the right guys in the right place. They wasted basically no time jumping into the fray here. Haya was, officially announced as the executive chairman just, 3 trading days, if I'm not mistaken, after the Asino deal was officially closed with Shenzhen Gold. And the path forward is pretty clear. I mean, this is a team with ample access to capital given their previous successes. The company just raised, a good chunk of capital, 17 million at a $1.10 Canadian with no warrant attached. So that speaks to the terms that a team of this caliber is able to demand of the market. And they're going to push this project forward at a rapid pace. There's already been significant amount of historic work, dating back to the 1970s at the project. And they think that they can take this from its current state, through a feasibility study in late 2026. And, also their familiarity with the, Namibia, permitting scheme there. They also believe that a mining permit in hand in late 2026 is very realistic. So that could, in a very best case scenario, everything lands properly, get the project towards a construction decision in early 2027. Knowing this group's track record, it's likely that they will then look to hand it off to a larger producer that's looking to take it forward. Whether that group is Chinese or Western remains to be seen. Haya has had experience selling to both Western and Chinese parties. And Namibia, importantly, seems very open to business to both Western and Chinese parties. So I don't think there'll be a lack of suitors for a project of this size. And the company's main challenge or objective in these next 12 to 24 months is to prove that the project works at current copper prices. Obviously, if copper runs to $6 or $8 per pound, which I think is quite reasonable in the coming few years, the numbers will absolutely scream in terms of economics. But at least my investment philosophy is not to make investments that are contingent upon higher metal prices to work. And Haya has been quite clear. Like he's not an optionality guy. He doesn't like to buy projects that are out of the money and at current metal prices and depend on a 50 or 100% uplift in metal prices. He likes projects that work, rapidly aggress them, and then sell them on to a bigger party to take forward. So he's convinced that this project works, in the 4 to 450 copper range. There is some skepticism out there. The project is not high grade. That is fair to say. Its current resource is 0.35% copper. It's important to note that doesn't include any molybdenum or gold byproducts. It's likely that will increase the grade by another 20%. So we're talking maybe 0.42% copper equivalent. So that definitely doesn't jump off the page, particularly for an open pit project, or even for an open pit project. But given the scale of the resource, the proximity to infrastructure, including water, the project's low altitude, there's a whole host of other variables that's very much working in its favor. But that's the big unanswered question. The company's planning to put out a updated PEA, which will be the first economic study with the new Koryx team in place and in Q3, and then a pre-feas in late 2025. Maybe that could slide into early 2026. We'll see. And those will be that'll be the key litmus test of whether, at least on paper, this project works in the current copper pricing environment. But I have a lot of faith in Haya and his team. To my understanding is over 80% of the Koryx team now is ex-Asino. So it's really an Asino 2.0 story. They're convinced that it works, and I want to give them some runway to prove that to the market. And I think if you look at the multiples of major copper transactions over the past 4 or 5 years, even if you look at the very lower bound of the PNAV multiples that were paid, we're looking at a triple from current Koryx levels. Assuming that they can prove that this works and sell it on to a larger party. And that is that is also factoring in additional dilution that will be needed to take them through feasibility. So that's kind of the thesis in a nutshell. Mm-hmm. I don't know if you have any comments or questions.
I definitely,
I think it's a pretty neat and tidy story.
Yeah, I've got a number, but it would probably take more than 5 minutes. But let me just get to the most salient point. So you made the point that you participated in financings, you've been buying on the open market. So clearly you think there's further value to be had here, despite the fact that it is well above your cost base. It's currently about $1.20 a share on the TSX-V. So what would you say today is the biggest catalyst that you see in the next 12 months that could bring a re-rating to a higher valuation for Koryx?
Yeah, I think it's that first economic study, putting the numbers on paper. Previous management team here, Deep South, envisioned a bioleach only operation, which actually had tremendous numbers on paper, but for a whole host of technical reasons was just unrealistic. So high-end team here are going to integrate what they call a hybrid flow sheet, where the higher grade material, which is probably basically anything over 0.25% copper equivalent, is going to be run through traditional milling process that will allow for the recovery of byproducts as well. And then perhaps for the lower grade material, there will be a separate bioleach flow sheet there. But it'll be this upcoming PEA slated for Q3 will be the first time that the public economic report has come out using traditional milling and flotation flow sheets. So I think that's far and away the biggest catalyst that's in the calendar. Perhaps there's some upside surprises with the drilling, but I think the extent of the deposit, the grades that are exhibited are pretty well known at this point. So this is less of a drill story and more of a story of showing that this works at scale.
Yeah, I mean, if they can demonstrate a $1 billion after tax, net present value at $4 copper, then I think you're going to make money, Matt. So we will follow Koryx and we'll check up in 6 months or 9 months and see how that thesis played out. Matt, thank you so much for your time. This will be up on my Goldfinger Capital channel on YouTube in the next couple of days. Thanks everybody for tuning in. Cheers.
Thanks, Robert. That was fun.